So a price chart has the price on it, right? Well, how do we show the price? Japanese candlesticks are one of the most popular ways to do it, and that's because the patterns that they form can help you decide when to buy and sell. In this video, I'm going to define them and then show you all the different patterns you'll need in your trading. Hi guys, I'm Jasper, market analyst for WeTrade and founder of Trading Writers, and I'm here to help improve your trading education. It's important to understand both the opportunities and risks involved. Online trading can be rewarding, but it also carries significant risks, including the potential loss of your invested capital. Make sure to educate yourself and consider your risk tolerance before getting started. Right, so possibly what's happened is you've seen a candlestick chart in your trading platform, maybe the WeTrade app. It looks like this. And you can see them for any market you want to trade, whether that be Forex, gold, or Nvidia stock. Today, I want to talk about what this thing in the app is actually telling you and how you can use it to trade. Back to basics. A chart, as we know, has two axes, price on the vertical axis, time on the horizontal axis. Japanese candlestick prices are like the format for the chart, the same as you can have a pie chart or a bar chart, which is also popular for trading. Ultimately, candlestick charts show how the price has performed over time. A candlestick has four important bits of information in it: the high, the low, the open, and the close. The high is just the highest price reached within at that time frame, and the low is the lowest price. The open is the start of the time period we were measuring, and the close is the finish of it. We often think about markets opening or closing for a day, but with candlesticks, we might even be talking about the open and close of a minute. All this information, when drawn as a candle, gives us the body and wicks. The body is drawn between the open and the close. The color of the body will be one of two colors, depending on whether the price closed above or below where it opened during the candle's time frame. The Japanese typically left the body clear for up periods and filled it for down periods, but green for up and red for down is now possibly more popular. The upper wick is drawn between the high and the close for the up period, and the open for a down period. The lower wick is drawn between the low and either the open for an up period or the close for a down period. Now ask yourself a question. Do you need to know about every tiny change in the price? The answer is almost always no. What you want is just enough information about how the price moved to inform your decision whether to buy or sell. In a candlestick chart, you can get to choose how much information of the price movement you see by selecting a time frame. The typical time frames you see are 1, 5 minutes, 15 minutes, 30 minutes, 1 hour, 4 hours, 1 day, and 1 week, and 1 month. The way it works is that each candle will represent one of those time frames. So for example, on a 1-hour candlestick chart, every candle represents 1 hour's worth of price change. So you might have 3 days worth of 1-hour candles displayed in your so-called 1-hour chart. What's so appealing about candlesticks as a type of chart is that the way a candle looks conveys to you some important information. Let's start with the body of the candle. A bit like an animal's body tells you about strength, a big tall candle is like a rhinoceros or very strong market. It shows intense buying or selling pressure. But a little short-bodied candlestick is like a bunny rabbit of markets, quite weak with little buying or selling. The candle's wick is an interesting one. It's a sign of how well the buying or selling strength lasted. A short wick tells you that most of the trading took place near the open and close. A long wick shows you that either strength or weakness got reversed. For example, if a candlestick has a long upper wick, it means that the buyers pushed the price up during the period, but then sellers came in and drove the price back down again before the period closed. Vice versa for a long lower wick, with sellers first, then buyers coming in afterwards. Okay, I hope at this point you get what a candlestick chart is. If not, rewatch the video up to this point before you move on to this next section, which is really the good stuff, the candlestick patterns. The idea is that candlestick patterns repeat over time, and when you learn to recognize them, they offer some important clues about what the price is likely to do next. I'll just say quickly now that I made some other videos about chart patterns. What's the difference between a chart pattern and candlestick pattern? The main distinction is that there are anything from 20 to maybe even 100 candlesticks in a chart pattern. Candlestick patterns, by contrast, consist of 1, 2, or 3 candles. So as such, candlestick patterns only tend to impact the next several candles, whereas chart patterns have a much long-lasting effect. Right, I'll start with 1 candle patterns and move up from there. A doji candlestick pattern has the same open and close, so it looks just like a line in the middle. So the only thing that can be different is the wick. A doji with a long upper and lower wick is called a long leg doji. A doji with no upper wick and a long lower wick is called a dragonfly doji. A doji with no lower wick but a long upper wick is called a gravestone doji. What does a doji tell us? Well, it's what you might expect. Neither buyers nor sellers could take control of the market because it couldn't close higher or lower. It just closed exactly where it opened. It basically signals indecision. I like dojis best after several wide body candlesticks because it often shows indecision at what could be the end of a trend, so it can be a good reversal indicator at that juncture. A hammer candlestick was well named because it basically looks like a hammer. A short body at the top, which can be any color with a long lower wick. Now, a hammer must happen at the end of a downtrend because it is a bullish reversal pattern. Remember, bulls are the buyers. The way I tried this one is to place a buy order above the high of the pattern and a stop loss underneath the low. A shooting star is basically opposite to a hammer. It looks more like an upside down hammer than a shooting star. The short body is at the bottom and the long wick is at the top. It's a bearish reversal pattern, so it happens at the end of an uptrend. Remember, bears are the sellers. A bearish reversal pattern helps you call the top of a market. So for this one, I placed my sell order underneath the low of the pattern and my stop loss above the high. A good rule of thumb for hammers and shooting stars is that the longer the wick relative to the body, the more reliable the pattern. I like to aim for the wick to be 3 times or more the length of the body. It's also worth noting that if there are 2 hammers with matching lows or 2 shooting stars together with matching highs, they are called tweezer tops and tweezer bottoms respectively, and are even more reliable and can forecast even bigger price reversals. The engulfing is a 2-candle pattern where the body of the second candle engulfs the body of the first candle. In a bullish engulfing pattern, a bearish candle is immediately followed by a large bullish candle, and as you might have guessed, is a bullish reversal signal. In a bearish engulfing pattern, a first bullish candle is followed by a larger bearish candle and is a bearish reversal pattern. To trade a bullish engulfing, I will place my buy order at the close of the second candlestick and my stop loss under the low of the first candle. If the second candle is very big, you can wait for a pullback to a lower price after the second candle is closed before entering. A harami is the other way around to the engulfing and of course has another meaning. Here the first candle is a long body and the second candle is a smaller one. Specifically, the body of the second candle must be contained within the body of the first candle. This second candle represents a period of pause after a big move, and this pause either means a rest before the move continues, or it reverses. When I'm trading harami, the orders I place depend on the situation, and this is something I talk about more in my trading strategies lessons, but the basic idea is to place your entry and stop loss on either side of the second candle and wait for the price to break out. There are far too many candlestick patterns for me to cover in this short video, as much as I'd love to because these things are so valuable in my trading. If you want to learn about those, I'd recommend buying the book of Steve Nisson. He is the godfather of candlestick patterns because he is the first one who learned about them in Japan and translated the ideas into English. That said, these 5 patterns I've shown you here are my bread and butter, and in my opinion, they, along with the right context in the chart, are just about all you need. So that's it on candlesticks. Make sure to check out my complimentary video on chart patterns because by knowing those as well as candlestick patterns, not to mention trends and support and resistance, you're well on your way to being a solid technical analyst. As always, please smash that like button and subscribe to see more videos like these as soon as they're released. Thank you very much for watching and happy trading.